Excellent. I think we are now live and over to the panel. If I could invite all of our panelists to turn on their cameras and unmute themselves, and we can get started with today's session. So today we have a fantastic session, and I'd like to thank everyone for joining us. We're here to tackle the question of how we integrate ESG into core investments. My name is Dominic Grocott. I'm a senior ESG manager at Rio ESG. For those of you who don't know, Rio ESG is an AI-driven platform which enables managers to streamline ESG due diligence, to extract investment insights, and to communicate to a wide range of stakeholders. So I'm joined today by Elena Tedesco, who is a co-portfolio manager of emerging market strategies at Federated Hermes. I'm also joined by Dr. Mahmoud Mohadin, who's an executive director at the International Monetary Fund, Stephen Puyat, who is global head of funds, ETF and capital markets worldwide at Euroclear Group, and Sam Tripanui, who is the lead product strategist and a member of BlackRock's sustainable investment team in EMEA. Our final panelist, Hawazin Nassif, unfortunately can't join us today. She has come down with an illness over the weekend, so we wish her a speedy recovery. Nevertheless, we'll still have a fantastic session. I'd like to remind everyone to submit their questions via the text chat box, and we'll try and get to as many of them as possible. So to kick off the discussion today, we're going to be talking about ESG products and ESG product building. So I'd like to start with Sam, if I may, by asking, could you provide us some context for this discussion by framing BlackRock's views when you define ESG in the realm of ESG risks and ESG products?
Yes, of course. Thank you, Dominic, and good morning, good afternoon, everyone. Let me start that by defining what we actually mean by ESG. And quite simply, that is the myriad of environmental, social, and governance risks that may be material to companies' performance and operations. Now, quite clearly, ESG investing or sustainable investing is the combination of traditional investment techniques with those environmental, social, and governance insights to deliver better long-term risk-adjusted performance. This is quite key. It is about risk. It is about performance. There is no allusion here to an ethical consideration or to trying to solve the world's great challenges. At BlackRock, we've been very vocal over the past few years that we believe environmental, social, and governance risks are investment risks. So as an investment manager, as a manager of risk, it is beholden on us to consider and monitor these risks in our portfolios alongside all of your traditional risks on behalf of our clients. That is what ESG integration is, the consideration of ESG risks and opportunities in the investment decision-making process. It cannot be a one-size-fits-all approach in that material risks or investment processes will change portfolio to portfolio, asset class to asset class. Equally, it is not about applying exclusions or taking a view that one sector or one company is good or bad, but rather making a judgment on whether a sector or a company is a good long-term investment when we consider the changing world and the various megatrends that are out there, such as the transition to a lower carbon economy or the rise of a stakeholder economy. So this is something that we try and do across all of our portfolios. The challenge perhaps in passive or index investing is, of course, the lack of discretion that a manager may have. We have to track an index as closely as possible. And that is where the role of engagement is particularly important, and the role of ESG indexes. And that leads quite nicely into ESG products. And here there is some differing views. Some managers will say that if they're integrating sustainability across all of their portfolios, then all of those assets are sustainable by nature, whereas others, including ourselves, only consider assets to be sustainable if they are in dedicated sustainable or ESG products. And that is because we differentiate between ESG integration, which is the consideration and the process, to the outcomes you get associated by being invested in a product. And those outcomes that you get from ESG products can be seen on a scale or a spectrum. At one end, you have that classic exclusionary approach: do not be invested or exposed in sectors or activities where there are risks. Now, those could be long-term sustainable risks, they could be reputational risks, and so on. Through your classic ESG investing, where you're trying to have an improved profile versus a benchmark, something quite as simple as a reduced carbon footprint in the portfolio, all the way through to your highest bar, which is impact investing, where you're trying to have a real world outcome alongside your financial objectives. This idea of impact and real world outcomes will be addressed further by the panel. But to round off, I just really want to make that final distinction clear between the intention of the real world impact versus ESG investing, which is firstly the consideration of risk, and then any outcomes from the product being portfolio level outcomes only.
Fantastic. Thank you, Sam. So Elena, if I could come to you now, just to carry on this sort of same theme of ESG products. You launched an ESG Emerging Markets Fund back in 2012. So it'd be good to understand how your experiences of launching an early ESG fund have influenced the way that you've subsequently developed your product strategy.
Thank you, Dom, and good morning, good afternoon, everybody. Absolutely, I think to Sam's point, there's a spectrum of opportunities for investors, and at Federated Hermes, we've been pioneers in this area, ESG since the 80s. In 2004, we launched a stewardship service that allows third-party investors to engage using us and now leveraging our team, which is one of the largest in the world. And as you highlighted, we launched an ESG Emerging Market Fund in 2012 with the idea that emerging markets are lagging behind and we need to integrate and engage with them, as Sam described, basically, to foster change. And then in 2018, the firm launched some impact fund and some SDG, Sustainable Development Goals, dedicated engagement funds. So we offer the entire spectrum from engagement only to integration and engagement, but also, the far extreme, let's say, of impact and sustainable funds. The point I want to make, though, is that obviously the innovation and the newest frontier, let's say, of impact is obviously crucial, but it needs to go hand in hand with the more mainstream approach, simply because we can't just throw away the old business models, especially in this region. We're talking about Saudi and the rest of the Middle East today, and clearly, fossil fuel is a key part of this economy, and we need to think of ways of transitioning forward. And I think investors have a role to play in this, obviously in highlighting the risks, highlighting the opportunities, and having a conversation with companies, engaging with boards on the future forward. And that's something we firmly believe in, and our experience has been positive so far, because when we have engagement on strategic issues with management, how they need to change their business models, the CEOs show up and they want to listen and they want to engage in a conversation and talk about what they can do and what they want to know about others, what the others are doing. And I think this is important because on one end there's the environmental imperative, and obviously moving forward, for instance, renewable energies and sustainable types of production and consumption. On the other hand, we also have the social challenges, and just transition is a key element to consider. So I would say that the reality that we face is very complex. There's a spectrum of investment approaches, as Sam highlighted, and there are several approaches that we can take to drive change and possibly build the back forward and better.
Excellent. I mean, so you mentioned the ideas of transitioning and enabling companies to transition. So actually, I'm going to come to Stephen now. So as a provider of financial market infrastructure, what are the risks of ESG investment creating a privileged marketplace? And I want to ask that in the sort of the frame that in the idea of helping companies to transition and ensuring that we're not letting regions or companies sort of be left behind by the creation of ESG as a sort of a criteria for selection.
Thank you, Dominic, for the question. and hello everyone, morning and afternoon. I think this question is really central to the evolution of this ESG path that we are just observing. It is clear that ESG is not going to go away. I mean, this is now a key part of the entire financial ecosystem. And as Sami and Elena just highlighted, pioneer and risk management expertise are fine-tuning all over the place and for the good of the market. So that's very, very good. The challenge is indeed that the most in need are probably issuers of emerging markets. And the one that are the most advanced for now are probably the advanced economy. And so there is a bit of a risk that actually the universe of ESG funds are more going to be centered around advanced economy and less there to come and support emerging economy. And sometimes emerging economy are not that emergent, you know, they are very important economies worldwide. And they are the ones in needs of transition and the like. And if we are not able as a market infrastructure to support the emerging market economy and to bring them closer to the international investors, then there is a risk that indeed we are potentially going to see over time a two-tier type of development. On one side, the advanced economy, and on the other side, the emerging market economy, which could potentially be seen as a second-class citizen, which would be really, really sad, because that is absolutely the opposite. The one that should be on the forefront are certainly the emerging market. So that's why we're working with the Saudi, we're working with the Egyptian market to connect them to the Euroclear international backbone. The connectivity is the first step. If you have the right connectivity, then you are ready to support the ESG transformation. But it is really important that together we understand that those emerging market needs to be properly connected at the same level with the same feature as international investors, I mean, domestic capital market are. Now the flip side of it is that if we make those taxonomy too complicated, not appropriate for emerging market because of the benchmark that are not equivalent, as we just talked about earlier, fossil oil, energies and the like. If you put your trigger too stringent, you just kill them. So instead of bringing them on board, you take the risk to exclude them from the economy, and this will be disastrous. So that's why we are working very, very closely with a world leader, with the World Bank at the G30 level, as well as the G20 level, to make sure that with the World Economic Forum, we are taking a global and sustainable view on integrating every single market into this exciting but challenging ESG universe of funds and other instruments.
Thank you, Stephen. So Dr. Mohideen, just to come to you finally, you were you previously, prior to joining the International Monetary Fund, you worked on developing the SDGs, who, you know, the SDGs are about providing a more sustainable future for all. So, you know, listening to what Stephen is saying here about the potential of creating a second class of citizen if this isn't managed correctly, what would your sort of thoughts be on enabling the ESG movement within emerging markets and within a regional context?
Right, thank you so much. Well, at this hour in Washington at 5:20, I'd like to wish you all good morning, good afternoon, and perhaps good evening as well. Let me just build in answering my question to the excellent interventions by Sam, Elena, and Stephen. Elena mentioned something about 2012 when she was doing her ESG fund. At the same time, the global community were gathering in Rio to start the discussions about SDGs. This is the Rio +20 meetings that ended by having the Sustainable Development Goals, which were launched in September 2015. A couple of months after, we had the Paris Agreement in 2015 as well. A couple of months before that, in July, we had the Financial Development Framework. So let me try to link what's happening at the micro investment level with the country level and perhaps the global level as well. And in a way to try preventing having this kind of dichotomy or multi-tier system that will have serious implications on divergence and confusion. So ESG before that date were basically something nice to have. CEOs of big institutions would consult, yes, let's do some environment, social, and governance work. They were very much confused with the corporate social responsibility. They were not factored in the work as such. And then they graduated, perhaps as Sam mentioned, about them being an investment class, but now more importantly, in guiding the way that we conduct business. And now we see this kind of very big movement coming from government policies, regulatory changes, market dynamics, and fear and concerns of reputational risk if you deal with the general public. Just 48 hours ago, in Canada, for instance, we have seen that the Supreme Court ruling on national carbon pricing. This is transformational, not just for Canada, but for many OECD countries. That you have now all of the elements in government, executive, legislative, and in judicial part, telling you that this cannot go on, and now we need to factor that on in the policies that you have. So this is the first part, that you need really to include all of these externalities in the business plan, not to have it as a kind of an isolated asset class, as it happens today, but now by regulations, and I really feel all the sympathy to those who are working in this area, because unlike regulatory standards in the financial sector, or accounting standards or auditing standards, there is a plethora of references that is very much confusing. And we see some interesting development now in matters related to disclosure, to make disclosure mandatory. And many countries like the UK, New Zealand, and others had already started, and the European Union started this issue of mandatory disclosure to prevent ESG washing, greenwashing, or SDG washing. Then from the market side, you see this kind of non-price competition. Many institutions, as we heard, claim, and they are right in doing that they are doing something better and different now in trying to do well and do good, linking the financial returns with impact in the market. But that again needs, as I said, more inclusion of the externalities and better information disclosure. And then you have this issue of investment that, as mentioned by Elena and Stephen, that in order to manage that well, we are going into big transition. Transition for me means investment, means restructuring, means opportunities for companies and countries alike towards this kind of better alignment with better standards. And here it is not just the issue of advanced economies and emerging markets kind of challenge that we are facing. Here we need really to have the three elements speaking together at the same time. We have sustainability narrowly defined to mean only climate change and investments in climate change. This is wrong. Climate change needs to be put within the bigger framework of the Sustainable Development Goals, which basically 17 goals dealing with challenges related to education, social aspects, investment in infrastructure, matters related to governance, big G here, not the G of the corporate, but governance of countries. That needs really to be the bigger framework in order to avoid having a multi-tier system. So what we are trying to see now with these good developments, with many institutions from 32% back in 2018 or 2019 to 72% of institutions saying that they are conducting a structured methodological evaluation of non-financial disclosures. This means that there is some sort of dynamics in the market and the market participants towards convergence to this new, better alignment on how to inform better, how to include and price externalities better, and how to invest in order to manage this issue of transition and restructuring. That is going to be more guided by better regulations and better coordination between the standard setters in order to have a better aligned market than the kind of fragmentation that we see today, and the great concern on high risk that we are really seeing in many cases, as I said, greenwashing and ESG washing by companies claiming that they are doing something but not really adhering necessarily to rules of engagement.
Excellent. Stephen, I believe you got something you want to add into the end of Dr. Modin's comments there.
Yes, thank you. I think there's one element that is really important for us at Euroclear when we looked at this array of greenwashing and the challenge that ESG represent in many ways. And in fact, this is, earlier I was talking about second-class citizens between countries, but in fact, we also observe second-class citizens as an asset class ESG. The ESG today, they are still struggling from high liquidity ratio compared to traditional funds. And so therefore, they are less entailed to be taken by the central bank against provisions of liquidity, credit liquidity or cash liquidity in local markets. And so if the entire ecosystem consider them as not as resilient and attractive as traditional securities, then in the long run, we have a problem, because we are going to make those asset class, second-class citizens themselves as well, which is really important, that addressing the problematic of liquidity, addressing the ability and the level of confidence and trust that collateral takers are able to take those securities at the exact same level as the traditional is extremely important in the ecosystem. Euroclear, you probably know, but it's really important to put some numbers here. We have 33 trillions of assets under custody in our ecosystem. It's roughly speaking is a quarter of the world economy and or capital market, I would say. And if only those ones will transit into ESG type of instrument, it will be enormous. But we can only do that if everyone is putting a piece of the puzzle together with us in order to create those asset class as liquid and as attractive as traditional bonds or securities. And this is really important if we want to support the transition, because most of the time those countries or those issuers, to start with, they are struggling with the ability to be attractive to the international investors. So that role we all have, and I think the asset managers are playing a fantastic catalyst and enabler in that exercise. They are extremely important to push those securities in the right pocket to international investors. But I just wanted to highlight that, because there is clearly a risk of greenwashing and dissatisfaction from the market if we're not careful.
Great. Sam, Elena, I don't know if there's anything you want to pick up on there. And there's quite a lot that's been pushed back onto the managers and the product building side. Anything you wanted to highlight and jump in with?
Sure. Elena, sorry, do you want to go?
Go ahead. I'll follow. Don't worry.
If I just pick up on this point of greenwashing, as a large asset manager, what we do is we deliver products which are appropriate to our various client bases across the world. And greenwashing is obviously something that we certainly don't want to be associated with, because it would mean that we're presenting something that it's not, whilst trying to get investors to invest in our products. This becomes, I think, really important when we consider one of the drivers of sustainability and ESG investing is this idea of movement of capital to millennials. More and more, we're trying to get younger generations to save more. And people are using sustainability and the narrative of ESG to help engage with these potential savers and so on. And this is particularly pertinent when we think of kind of larger pension schemes and institutional investors and so on. Now, what we want to do is obviously avoid greenwashing. And generally, I think it's a self-policing industry. All the big asset managers do not want to be associated with that. we're seeing regulation, and particularly in the EU, etc., catching up with that kind of self-policing. What we also want to make sure that we do is when we explain what these products do, that they make sense to people. And Stephen and Mr. Medin kind of touched on all of this with regards to the securities that are available, particularly with things like green bonds, etc. What is in the realms of the possible right now? What does that actually mean? And then what more can we do becomes more and more important. So from a product development perspective, we're really at the start of a much bigger move, in my opinion, particularly as we start moving towards things like the UN Sustainable Development Goals. What products are there, what securities are there that allow us to build products, which then help meet the requirements of all of those individual savers or institutional investors and so on. Sorry, Elena, over to you.
Thank you, Sam. I want to add that I believe the investors are reacting to the challenges and opportunities. And to Stefan's point about liquidity, I agree it's low, but it's actually increasing. I mean, all those that have managed to position themselves without greenwashing, clearly demonstrating ESG integration or impact, whatever, the spectrum, they want to sit on the spectrum. They've seen massive flows. This asset class is booming, clearly, and there's a lot of appetite for that. And the regulator has, rightly opened his eyes and started to, stop the greenwashing exercise. And we think this is an opportunity for us because we take it seriously, and we'd like, the others that don't take it seriously to be called out, for what it is. Surely it's not simple to comply with the new regulation, the taxonomy, the SFDR, etc. But it's good to follow the same principles that, the European Union, I mean, I don't want to talk about Europe, but I think it's an easy example to make. Ages ago, they decided, if something is not champagne, you just cannot call it champagne. If something is not Parmesan, you cannot call it Parmesan. And equally, if it's not green fund, you shouldn't call it green fund. And I think it's the right approach and helps everybody, the asset owners, the investors, and the clients, human beings. But the risk in an approach that is a bit, too quick and want deliver results immediately is over-reliance on scores and quant measures. And I think we have to be honest, and some areas are not easily measured with scores, especially in emerging markets, where the standards of disclosure are lower, and then there's complicated issues to deal with. So I would say the trajectory is right. As investors, we want to play the role, but we need to be mindful of how things happen. And I think fund managers should not outsource their job to ESG scoring agents or quant boutiques, because they still need to integrate, understand, and have responsibility in engaging directly, not outsourcing everything to ESG scoring agencies.
Excellent. So we only have about 5 minutes left. So if anyone has any questions from the audience, please do get them in now. So I mean, Elena, just touching upon the reliance on scores and measures, and thinking about that in a regional context, building from what Stephen said, whereby perhaps the same scores and measures that we're using in sort of the developed economies through the EU taxonomy and whatnot are less relevant to emerging markets. Perhaps I could frame this question as saying, to what role, so how do we integrate, how do we conduct our due diligence within emerging markets with a regional context where they are emerging and rather than developing?
Our approach.
Okay, go ahead.
Sorry, was it to me or?
Yeah, well, anyone. I sort of threw that one out there, but Elena, if you want to give a brief answer.
Very quick for me, and happy to hear other people's voices. But our approach is bottom-up based. So obviously we are aware of the good principles of governance, for instance, diversity, independence, etc., disclosure, and the issues. But I think the best approach from an investment point of view is bottom-up. So understanding the challenges of a given company and industry, and having this sort of conversation on material issues that CEOs are going to want to talk about and listen. examples, if it's about energy, we need to talk about transition into renewables. If it's about services, we need to talk about how they deliver the services, banking, responsible banking, etc., etc. So I think we need to combine the two things, understanding of investments and the stocks with an overlay of standard principles.
Right. If I may just add, in addition to this bottom-up approach, which is important and good and more democratizing the process, a bit of a top-down approach as well through the bigger role of the state. Now we're seeing the state getting bigger around the world with such big investments, from the $1.9 trillion here and the stimulus package in the US to the recovery fund in Europe, to a variety of huge public spending, even in our region, in MENA region, which are basically telling you two things at the same time. That there are opportunities because many or much of these investments are about inclusiveness, about infrastructure investments, about investment in education, in health, and other aspects that you can translate into the UN Sustainable Development Goals, but they are investment opportunities with huge magnitude. The other thing that is not just coming from government, I appreciate, of course, the good work by different corporate leaders, including issuance of letters to encourage the supply chain to comply with rules and all of that. And we have seen IFC impact investing principles. We have seen the Global Investors for Sustainable Development issuing their own definition. But the big game changer here is going to be coming from the standard setters, the regulatory agencies, especially in the regulated sectors of the financial system, in addition to the work of the accounting firms and the rating agencies, trying to factor that these all changes in their way of monitoring and evaluation beyond ticking boxes. So I think the whole incentive structure is really changing very fast to include, in addition to our, even the definition of asset is moving from financial assets to fiscal assets to assets related to nature, as defined recently by a very important review, the Skupta review, which is being used now as one of the references to the COP26 on climate change. So there are lots of great deal of changes here and there. Some of them are coming bottom up, as mentioned by Elena, but others are coming from the top-down approach, some as incentives, regulations. It's the old carrots and sticks and their own dynamics working in the market today, and it's better to catch that soon. You don't need to play catch up in this game.
Great. So Sam, if I could come to you now, to what extent does it require a top-down regulatory approach versus a sort of a bottom-up engagement approach from the management perspective?
I think it really needs to be considered in both ways. Now, I'm going to take the view of BlackRock's clients, really, and what we're talking here is the broad spectrum of institutional investors, wealth investors, private banks, family offices, and so on. And we have to understand that the way that they invest is going to be driven by asset allocation. And we can think top down with regards to how do you make those strategic asset allocation choices, because that's going to take into consideration your developed markets versus your emerging markets, your equities versus fixed income allocations. And then within each of those building blocks, we can do that bottom-up approach that Elena mentioned, where we're thinking about the risk of individual companies, where we want to target engagement, etc., and so on. So it's very important that when we think about this from an investor mindset, we're thinking about it both top-down and bottom-up, because that's what you can do. That's what we're going to have to do to drive the kind of changes that people are looking for.
Great. So just to wrap up, because I know we're running quite short of time, I'd like for each of our panelists to provide our audience with some takeaway, some key message that they believe is critical for them to leave this this webinar with, or this event with. So I don't know who would like to go first on that. If anyone, show of hand.
Well, I can briefly give the Euroclear point of view. I think one of the biggest challenges we've seen in the last 5 years is the ability to benchmark and compare different countries, different issuer types depending on the letter that we're talking about, ESG and the like. And unless we find a way to streamline and industrialize the process in a very efficient way, we will still bump into fragmented, short tickets, small liquidity and the like, and that will be damaging in the long run. So, well, as I said earlier, we're working with the World Bank and the World Economic Forum in order to try to put what we call an ESG program, which will facilitate the comparability between different countries and different issuer types around the world, so that the asset manager can do their job properly, fast and efficiently. And the more we will industrialize the process, the better the outcome will be. So for us, it is clearly time to put in place that ESG 2.0, I would say, infrastructure setup, in order for the market to really start to mute into the right direction.
Thank you, Stephen. Elena, perhaps I could ask you next. What would be your practical advice for our audience to take away from this?
I think we need to do more of this, more roundtables, more conversation, more multi-stakeholders talking about these issues and trying to come up with solutions, innovative solutions, innovative way of doing things. So without throwing away the past, but thinking of the future together, because we need to get better, basically. And something that we've mentioned a lot was integration, engagement, but we also need to consider advocacy, and that's kind of the middle ground, right? When you look at the top-down view, sometimes we should get together as investors, stakeholders, regulators, etc., and try to find common solutions, because these fields are evolving, and we need to talk more about how to tackle education. A lot of money is going into climate. What about education? What about gender? The gender is neglected as an investment area, and it might be the next area for the future, and opportunity to make money. But we need to get together and find the equivalent of a Green Deal, the equivalent of a pink fund, something like that, to unlock more potential.
Absolutely, and I suppose that's a good time to sort of thank the AFE for putting on these events and for inviting us to be able to discuss these topics. And like you say, there are so many more topics and so much more we could discuss within this that we haven't got to. But Dr. Mohideen, perhaps you could provide a piece of advice.
No, this is great. Thank you so much for having me. Great discussion, and I share the advice of Elena that we need more of that going forward. But to summarize on my side, you call it build back better, you call it build forward better. We are up to the biggest restructuring game, lots of opportunities for investment. We started with Europe and Euroclear on the concluding remarks. Like to end with the president of the European Central Bank, Madame Lagarde, when she puts her 3 N's in order to deal with what we talked about. You need to better inform, include, and invest. So include by factoring in all of aspects related to asset management, inform by having a good criteria and benchmarks, as mentioned, to avoid any kind of washing, greenwashing, ESG washing, SDG washing. The third of the N's, it's investment, adaptation, mitigation, in technology, because all of these new deals are not just green, they are green at the same time. So these are basically the new dynamics that we need really to prepare all countries, not advanced ones, but emerging markets, and to have a more inclusive approach in our frameworks when they are being applied.
Right. And Sam, if I could, final words to you.
I think I would echo everything that my colleagues here mentioned. Now, we all come at this from slightly different angles in the kind of financial ecosystem. And I think what I would say is, last year was the first really big year in terms of movement of assets. And we're all on this journey and we're all learning, and the regulation is catching up. That harmonization across what people mean is catching up. And all of that's going to improve as the data improves, as the analytics improves, as the thinking improves, and so on. So we're at the start, but there's a lot more to come.
Fantastic. I appreciate all of your thoughts today. It's been a great panel discussion. I hope our audience have enjoyed it as well. So that's all from us, and back to the AFE for the next session.
Thank you.
Thank you very much.